Hi everyone, I'm Matt from Look Into Bitcoin, and today we're going to be looking at where is retail. To do this, we'll be using a number of resources that are all freely available on lookintobitcoin.com, your number one source for Bitcoin information. And if you haven't already, don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. So when we say where is retail, what exactly do we mean? Well, typically within the cryptocurrency space, we define retail as traders that may not necessarily have the best timing when it comes to their investments within the cryptocurrency markets. Maybe they get in a little bit late. Maybe they don't fully understand all the tech behind Bitcoin and cryptocurrencies in general. So we tend to refer to retail as almost bad traders, unaware of situations. But either way, if you're watching this, you're probably not retail. You're probably a little bit more past that stage. So when we say where is retail, why are people wanting retail in the market? Well, because as we said, they tend to come in with maybe guns blazing and just buy immediately, and this tends to push price up, and it really brings more masses and just more capital inflows into the market. It generally just is a bullish thing to have more retail interest in an asset. And right now, a lot of metrics are pointing towards the fact that we have almost no retail interest in Bitcoin and cryptocurrencies right now. So why is this? Is this likely to change? Is this a bad thing? Well, if we just look at the HODL waves right now, we can see this is looking at the percentage of each age band of network wallets on the Bitcoin network. So just to simplify that, if the 10-year ones, which is this purple one up here, this indicates Bitcoin that's been held for at least 10 plus years in each wallet. Then this lighter blue is wallets that have been holding Bitcoin for 7 to 10 years. And we can see the percentage of the total network that each of these bands make up. So if I just remove all of these slightly longer bands, because we'd assume retail would come in and not necessarily be interested in the asset for a number of years. They're likely just going to get in for a few weeks, maybe a few months or so, and just leave after that. Either take away with their profits, or usually because they tend to get in as the market's getting a little bit overheated, they tend to walk away with some losses. But if we just look to 3 months and below, we can say that this is typically more retail behavior, definitely retail age bands. We can see that right now this has been on quite a steady downtrend for a number of months now. If we go even lower and just remove that 1 to 3, we can see these tend to peak pretty predictably at market tops. We can see every time Bitcoin has more exponential price increases, this leads to a lot more of these shorter term wallets entering the space. But recently this has been, as we said, on a pretty steady downtrend. But I think a better way to actually gain an understanding into retail interest is, rather than just looking at the HODL waves, look at the realized cap HODL waves. Now this is looking at a very similar metric, but it's looking at the influence on the realized price that these retail wallets have, or all age band wallets. So the realized price is the average accumulation price for each Bitcoin. So if we just look at something like the 10 plus years, these have a very small impact on the Bitcoin realized price, a fraction of a percent really, because they were holding Bitcoin over 10 years ago. Therefore, their impact on the realized price is very small because they were accumulating when Bitcoin was at a very, very low price. If we look at something a bit lower, such as the 7 to 10, 5 to 7, for example, we can see this is a little bit higher, especially in these bear markets here, because potentially these 1 to 2 year wallets potentially bought at market peaks, and then as price comes down, they bought at much higher prices. Therefore, they're having a much greater influence on the realized price. But again, if we just remove all of these apart from the shorter term wallets, we'll just look to 3 months and below. We can see that these have a huge influence on the realized price. And again, these are timed very much at market peaks, and this shows much clearer, at least in my opinion, than the HODL waves, because this actually shows retail interest that are coming in and buying substantially. So again, we can see here this has been on a very steady downtrend, and is at quite a low value compared to historical averages. But I think if we go to the 1 month and below bands, what we can actually see is this is actually quite comparable to other stages in previous cycles. We can see here this very low numbers, this very low influence on the realized cap HODL waves, but really this is quite similar to what we see usually at the tail end of a bear market, or at least into the transitionary phase from a bear market into a bull market. We can see in each one of these examples, Bitcoin has bottomed out and is just starting to crawl up in price a little bit. We can see in each of these, it either marked the exact bottom or just after, like we could see in the most recent cycle here. And this is likely because as price decreases, retail are just generally not as interested. But then once price first initially starts increasing after we've set the low, a lot of people, again, are a little bit hesitant to get into the space. Maybe in the previous bull cycle, they bought a little bit too high and lost a little bit of cash. So maybe they're a little bit hesitant, a little bit more cautious to get into the markets. And we can see, unfortunately, this tends to lead to them getting in a little bit too late, and then in the end ending up buying considerably higher towards the market peak anyway, and then the cycle repeats. But as discussed, this is indicating a very stark lack of retail interests in the market currently. What we can then do is look at something like the Bitcoin active addresses, and again we can see this has been pretty stagnant for a few months, which is a little different to what we've seen previously. Even in the previous bear cycles we could see this after its initial correction after their all-time high did tend to slightly increase, but again I think this is not anything to be too alarmed at. I think in the previous cycle we did have comparable data action in this active addresses where it was very stagnant, albeit not for as long a time, but probably a similar phase of the cycle where we have this initial run up off the low, as many people potentially getting excited as Bitcoin first makes its climb up, but then we have some more sideways price action, maybe a little bit of downwards price action, and then we see this active addresses stagnate before hopefully we can kick off the latter stages of a bull cycle and see some exponential price action and retail rushing back into the space. Another way we can confirm this is look at some more third-party metrics. So here I've got Google Trends loaded up, and we're looking at the search terms for Bitcoin and cryptocurrency, and we can see these again tend to have a very positive correlation, very parallel price action, data action to the Bitcoin price. As Bitcoin's price is reaching an all-time high, lots of people tend to be Googling Bitcoin and cryptocurrency. If we just search for a more 5-year data point rather than the entire price history, we can see again that this tends to peak exactly when price action is peaking, and then tends to have a very long, almost bear cycle for this data, where we see long drawn out decreasing values as there's just less and less retail interest in the space. And it's really not a very gradual increase. We tend to see price action once we actually finally have the bull market really kicking off and the first sign of some exponential price increases. Retail tend to come back in a flash rather than a gradual flow. And especially if we look at something like we discussed previously for a third-party data point you could be watching. Here we're looking at the Twitter followers and interactions for Philip Swift at Positive Crypto on Twitter, the Look Into Bitcoin founder. And we can see exactly the same pattern here where as Bitcoin's price is increasing exponentially in the latter stages of a bull cycle, we go from just a few hundred new followers gained per month up to thousands and thousands of new followers. And right now it's very similar. We're just at a couple hundred new followers a month. So what we tend to see is rather than a gradual increase like we may see in some other Bitcoin on-chain metrics, retail tend to come back almost instantly. And this leads to a huge increase in not only capital inflows and volume, but usually volatility as well. One thing I actually noticed and tweeted about very recently is the market volume according to one of Bitcoin's larger TradingView indexes, which is the Brave New Coin BTC index. Comparing that inflow volume to the total market cap, we actually just set the lowest volume comparative to that market cap ever. So we can see here it's been a very generally trending downwards, which you'd expect as the market cap of an asset grows exponentially to generally decrease in relation to that. But to set the lowest we've ever set really does cement the fact that there are very few retail traders in at the minute. But what we can do is look at something like the addresses with a balance of at least 0.01 Bitcoin, the addresses holding at least 0.1 Bitcoin, and the addresses holding at least 1 Bitcoin. And we can see that these do continue to increase pretty rapidly to new all-time highs very consistently. So while there may be no new traders coming into the market, I think the traders that are still in the market continue to accumulate. I know I certainly am continuing to dollar cost average in, and I think a lot of people are doing the same, even though we've had a little bit of a price increase off the lows, so maybe it's not as much value for money, but timing the lows is very difficult to do. And even though we've had a little bit of a pullback from those recent highs we set above $30,000, again, people continue to accumulate. So I think a lot of people are taking advantage of the fact that retail aren't necessarily here yet and trying to stack BTC at a comparatively discounted price. So just to summarize, looking at a number of on-chain and external data sources, we can conclude that there is currently a substantial lack of retail interest for Bitcoin and cryptocurrencies in general. More retail interest typically leads to more capital inflows and purchasing for Bitcoin and rallying prices higher. Yet this usually coincides with market peaks at the tail end of bull cycles. So a low level of retail interest at this stage in the cycle is actually quite normal and comparable to previous cycles. And the longer we can actually retain a very low level of retail interest before a big boom of inflows from new traders and investors, the longer we actually have to accumulate cheaper BTC. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to get access to live chats, in-depth newsletters, indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And I mentioned it a little bit recently, but we do have some great new charts, features, and pretty much everything you can imagine going live on the site soon. And let me know in the comments down below and on social media. Are you looking forward to retail interest re-entering the crypto space to potentially rally prices substantially higher? Or are you really appreciating and taking advantage of the fact we have little to no retail interest currently, so you can maybe stack sats at a discount? As I said, let me know. I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.